Regional banks in focus once again today as the market digests the fallout of the First Republic failure and sale to JP The KRE Regional Bank ETF down a little more than 6%. PacWest, Western Alliance, Comerica, Zions, and KeyCorp leading the industry to the downside today. Now, the sell-off is a combination of each bank's commercial real estate exposure, level of uninsured deposits, a lot of various factors and variables that are causing them to sell off. The bearish thesis stems from the fact that First Republic's bondholders and stockholders were wiped out in yesterday's season sale to JP and the market is essentially revaluing its downside risk in the event that another regional sees the same fate. The deal also highlighted the power of the big bank balance sheet preferred by the FDIC in this case to acquire the failed bank out of receivership due to cost concerns. In a world of potential industry consolidation, though, this calls into question regionals' ability to compete. The timing is kind of unfortunate, too, coming off the heels of better than expected Q1 earnings last week, but right ahead of tomorrow's Fed meeting and amid the debt ceiling debacle. In a Goldman note to clients out a short while ago, the firm notes that this morning's sell-off was driven largely by hedge funds, specifically short pressure. The firm notes that the lack of a relief rally yesterday when the JP First Republic news was announced sent a bearish signal to the market, guys.
All right, let's dig a little deeper here. You mentioned one thing, and that is the level of uninsured deposits that some of these regional banks have. Why is that such a sore point? Are investors worried that that money is not sticky money and might flee to money market funds or other higher yielding alternatives?
Uninsured deposits, that's exactly right, Tyler, are seen as riskier forms of deposits because people look at what's going on, they feel the jitters, they start to have the concern that, there could be some sort of failure here. Uninsured deposits would be the ones most vulnerable. And so those are the ones that tend to be to leave the bank first. So
could bankers, regional bankers, ameliorate that problem by paying more on deposits? In other words, if I make more money on my deposit at your bank, I will be less inclined to flee to another kind of product.
So that's one response, but I think it depends on the risk calculation that each individual depositor is looking at, because they may pay more, but if the bank fails, that amount is worthless because you have the risk of losing all of your capital if it's uninsured at that particular bank. And that's why the FDC, we talked about this yesterday, that's why the FDC is looking at potential reforms to make people feel like their money is safe in these institutions and they're not going to pull them out. The risk of pulling out these uninsured deposits is that it affects the asset side of the balance sheet. There's a mismatch that's created, and that's the concern that the market has with regard to some of these, the flightiness of the uninsured deposits.
Fascinating answer. Leslie, thank you very much. Leslie Picker. Appreciate it.